Kia ora, welcome. Ngā mihi nui kia koutou, no mai, haere mai. Welcome to this Mindful Money online seminar. We were counting, it looks like about the 14th in our series, and they happen each Wednesday at 7 p.m. For those of you who haven't been on one of these seminars before, generally we book for around 15 to 20 minutes and then open up for questions and comments. We use the chat box on Zoom, if you're on Zoom, or comment pages on Facebook. Please do it as we go along, and we'll come to the questions after having an initial discussion. Tonight we're talking about building trust and sustainability in our financial system, and it's my great pleasure to introduce Rob Everett. Rob is the CEO of Financial Markets Authority. Good evening, Rob. Warm welcome.
Good evening. Kia ora.
So a brief introduction first. Rob's originally from the UK, as you will tell when you hear his voice. He joined as CEO at the FMA in February 2014. He has had many years of experience in investment banking, law, and risk management, including with Bank of America Merrill Lynch, working in Europe, Asia, and North America. I've asked Rob something personal, and he lives in a household of 7 and multiple animals. So our sympathies, Rob. Let's, without any further ado, kick off the discussion. I want to start off by asking you about the results of the recent survey you've done on trust and confidence in the financial system in a kind of post-COVID world. I think actually part of the survey was during COVID, a lockdown time. You know, one might think that there was a huge degree of nervousness about our financial systems, you know, particularly as people started to see share markets plummet. But that's not really what you found, was it?
No, that's right. Good evening, everyone. We were a little surprised, I have to say, at first blush when we looked at the results of our investor confidence survey. And that's a survey we do every year. We like to look at the trend information over time, and we use it for some of our performance measures too. But the kind of headline measures are around investor sentiment. And we were really surprised that it held steady from last year. And in fact, you know, and some of the scores didn't really seem to connect with what a lot of us were seeing with markets. But I think if you bear in mind that the survey was out in the market, it was being sort of tested with people at a period where the New Zealand and global markets had bounced back from a pretty catastrophic and sharp drop, and we're actually well on the way back towards the highs they've been at before COVID. So I think in New Zealand, the response to COVID probably was going well compared to the rest of the world. And so there was a sense of optimism, I think, that maybe the worst was over, and that people felt that their long-term faith in markets hadn't been shaken quite as badly as they might have been. So I think that's the explanation. I also think that markets then and probably now remain somewhat disconnected from actual economic conditions. And obviously, even those economic conditions with wage subsidies in a lot of jurisdictions and government, significant central bank and government relief probably haven't really hit the wall that we all know they're going to hit. So look, you know, at the point in time, these surveys, we were pleased that some of our messages about staying the course and not overreacting to market volatility appear to have been listened to. It'll be interesting to do the survey again, I would think, in a few months' time, when I suspect world economic conditions will have sort of come home to roost for some people. Yeah.
I couldn't agree more about that disconnect between real world economics and the financial markets. That something is obviously out of kilter, but we have yet to see what that might eventually look like. Some headline figures I saw, for example, 2/3 of people saying KiwiSaver's for the long term, and although some people switched their funds from growth funds into conservative, on the grand scheme of things, it was probably not as many as you may think.
Yeah. So we were very mindful of what would happen to KiwiSaver. For a lot of New Zealanders, KiwiSaver is really their only kind of market investment. And a lot of those people probably aren't very familiar or versed in markets ups and downs. So certainly we weren't surprised by a certain amount of switching, particularly switching from growth funds, which would have been hit quite hard by the market volatility, into conservative funds. Not as much as we might have feared, but we certainly saw some. And we saw some people switch multiple times, which is not a good thing, in my opinion. The providers of KiwiSaver had a massive surge in people calling up, wanting to understand what was happening, wanting to understand what their options were, wanting to have a conversation about whether they should switch funds. The providers and the supervisors have had a heavy burden with people looking at hardship withdrawal. So we expected, as and when we hit real market volatility, for all of that to pop. And obviously that was quite extreme for a few weeks. I think probably the survey and the more recent part of that survey tell us that most people listened and understood that KiwiSaver is a long-term product, and chopping and changing probably suggests you haven't thought it through properly in the first place. And we have encouraged people not to chop and change unless they've really thought hard about it, and preferably got some financial advice to put KiwiSaver into the overall context of their financial planning, so that they can make a coherent decision about it rather than just react to seeing a balance on a screen.
As you say, the any lack of confidence tended to be, from the results of the survey, a lack of confidence in the economic prospects, but not a lack of confidence in the integrity of the financial markets. You've obviously presided over a period where there's been significant regulation and re-regulation of the markets post the global financial crisis. Do you attribute any of that trust and confidence to their work, or is that being?
Well, I'm very tempted, Barry, to try and credit, obviously. Well, look, partly yes. I think everybody knows that after the GFC and in New Zealand, the finance company meltdown in particular, there was a reaction in terms of more regulation and higher standards of disclosure and licensing of providers, and some of that would have stuck. I think most financial services providers, and certainly the FMA and the CFFC, the Commission for Financial Capability, have been pushing that message that at some point markets will turn, and probably turn sharply. And we've had a very sustained period of almost unparalleled period of growth, really, since KiwiSaver started, or just after it started. And we are somewhat cheered by the fact that people, at least to date, have maintained confidence in the product, because KiwiSaver is a really key product for a lot of people. And yeah, the survey tells us that people feel regulation is doing what it should do. I think it creates an underlying, sometimes slightly nameless, just sense of confidence that someone is looking somewhere and will make providers do what they're supposed to do. I hope that continues to be the case.
Yeah. So one of the other things that I guess came out of the survey that you released today is people taking more interest in their financial investments and being more aware of KiwiSaver. Is that something that seems like a very positive development?
Yeah. Well, we have been struggling for years, actually, in this survey and elsewhere, to work out how to engage people with their investments, particularly KiwiSaver, because, as I've said, it tends to be people that aren't active otherwise certainly in investment markets. And we've pushed providers very hard to try and engage with people. This is the first time, actually, we've seen significant engagement with the KiwiSaver providers and the supervisors. We've seen significant uptick in retail trading, which we may come back to, because I'm not 100% convinced that's a great thing. And those questions that people are asking and the tracking that providers can do about how often people switch, or in fact, in some cases, people have been increasing their contributions and going into other investments. Since I've been in the job, which is 6.5 years, we've not seen this level of interest in what markets are doing and what KiwiSaver is doing. We also had projections for sums that might be available to people at retirement in KiwiSaver go into the annual statements for the first time this year, and that was very much, again, designed to trigger engagement. And that seems to have also hit the nail on the head, and that happened after this survey. So no, I have to say, for all the wrong reasons probably, i.e. market downturn and market volatility, we have seen greater interest in particularly equity markets. And that's been matched, as you know, Barry, in Australia, in the US, and the UK. In fact, pretty much every jurisdiction we've spoken to is seeing a surge in retail interest in direct equity market investing, which is, and fund investing, low cost fund investing. You know, which at least that level of interest is healthy. I do worry about where some of that trading has been going. So that's, you know, that's the flip side of that issue.
Yeah. So obviously, Mindful Money's kind of interested in the sustainability dimensions, the ethical dimensions of where money goes. And we do annual surveys, as you know, and then people have been showing increasing interest in that. Do you see that public interest in sustainability, in responsible investing or ethical investing, green issues playing out more over time? Is that something that you see? It's obviously not necessarily a question in the recent survey, but more broadly, is that something you see?
Yeah, without a doubt. I mean, we saw in New Zealand an early iteration of that when there was some media debate about cluster munitions and whether KiwiSavers and the funds that KiwiSaver funds invest in were invested in, you know, so-called sin stocks and the rest of it. But I think that issue around sustainable investing, socially responsible investing, ethical investing, whatever you want to call those various categories, is the single biggest growth area, certainly in fund management right now. So, you know, talking to people over in London, that issue of people taking an interest in managed fund investments as opposed to just leaving them and, you know, walking away and coming back 20 years later, and B, that interest often driven by a wish to understand what those funds are invested in. And some of the research we've done in New Zealand suggests, to at least to some extent, that people are often more interested in that than they are in relatively minor fee differentials between providers. Now, obviously, fees over a 25 to 40-year investment add up to a significant amount of money, so we want people to focus on that. But it is interesting. A lot of people feel the need to be comfortable that their money is invested in a way that they would themselves, and the fund managers are having to understand what that drive is, and we, the regulators, are having to work out how you monitor for that and how you make sure that actually some of these funds do what they say on the tin. So in New Zealand we have the supervised function, of course, which is important in that context. But yeah, this is going to be one of the biggest components of fund management going forward, and in fact, you know, all investment, the sustainability of it, whether that's the risk to the investment of climate change or whether it's the risk posed by that investment to climate change, you know, going to be huge issues. Yeah.
I was going to also kind of relate that to you and I had a brief discussion about your plans for the future, and you've obviously just filed a statement of intent, and you've got new positions coming into the organisation. Great position to be in, to be adding staff and adding capacity.
Indeed.
So
Indeed.
Can you talk a bit, because there's also a bit of a mandate change for the FMA as well?
Yeah, absolutely. I'll talk to that. I mean, nothing stays still for very long. So I did think I'd take the opportunity tonight just to mention the expansion of our remit, and as I've mentioned to you, climate change and climate related issues are going to be part of that. So we were set up as a successor to, largely speaking, the Securities Commission. Our mandate was investment products, investors, investment advice, investment platforms, investment markets. The government has been talking and has a bill going through select committee right now, looking at extending some of the licensing we do in that space to banks and insurers. So that takes us into a consumer finance space as opposed to an investment finance space. So that will be quite a big challenge. The banks and insurers, there's plenty of work to do there in terms of how they treat their customers and how they're set up in that respect. The government has also announced its intent to legislate to require climate risk related disclosures of listed issuers and another number of other entities. And I think the current proposal in New Zealand is to make that mandatory. We have been asked to be the monitor and enforcer of those disclosures, and the XRB, the External Reporting Board, will be setting the standards that we would monitor to. So we've also got a work stream with COFA, which is the Council of Financial Regulators, which is us and the Reserve Bank, Comcom, MB and Treasury, specifically to look at climate change in the context of contributing to a sustainable economy, but also, obviously, particularly from our perspective, looking at disclosures, making sure things like green bonds or social bonds or ethically badged funds do what they say on the tin. We're hiring into that space. I've got a couple of fairly senior positions which will have a clear mandate in that space. The government is talking to us about what resource will be required for that. And then I suppose on top of that, you've got fintech, which actually will probably end up crossing all of those pieces, where the use of technology to increase access, affordable access to financial products, so financial inclusion, and things like open banking, are going to tax us all, considerably in terms of how that fits with existing legal structures for the offer and sale of financial products. So yeah, a lot of remit change for us, but all in very interesting spaces, which I think the FMA feels that it's right that we should be in. And I don't think I'll have any problem, particularly on that climate related one, encouraging some staff to step sideways out of current roles into ones that are pointing in that area. I've got quite a young, driven staff, and it's obviously, as I say, one of the biggest things that we'll do.
Yeah, exciting times, as you say. Things certainly aren't standing still either from climate change and sustainability issues, or from technology and things like open banking, and going to be quite transformative. To all of those who are on Zoom and those on Facebook as well, we're going to just have one more question and then come to your questions. So please feel free to lob in questions, comments into chat or on the comment section of Facebook. Rob, I wanted to pick up on that last point. In previous seminars, we've had quite a lot of discussion around the work of the Sustainable Finance Forum, which is looking at how our financial system can be more fit for purpose and sustainable in the future, looking at less at the short term and more on long-term issues, more about issues of climate change, environmental qualities, financial inclusion, etc. Obviously, part of the answer to that is regulation, but I guess part of it is also conduct and the way that the system behaves, and whether or not the players are focused on what's good for the customer. And I mean, can you talk a little bit about some of the issues relating to conduct? I know that there's a lot of interest in the inquiry and what may come out of it?
Yeah, certainly. So I think there's two elements to that conversation. One is how financial services providers treat their customers, right from birth to death, if you like, from when they first engage with someone to right at the very end. And my view, which I think most of you will agree, was backed up by the Australian Royal Commission and our own work here with the Reserve Bank going into the banks and life insurers, is that that's an industry that's become quite complacent about its customers and talking to its customers and basically looking after them through good times and bad. And so that's a huge focus for us. I do think over COVID, to give credit where it's due, I think a lot of the providers that we have spoken to understood that this was a period where they had to step up and reach out to their customers and understand what COVID impact was having on them. And obviously, as I said earlier, when the wage subsidy drops off, a lot of banks and insurers are going to have to think quite hard about how they help their customers through that, because I think that will be difficult. So that's the kind of conduct mandate we already have in fund management and retail derivatives and a few other areas, which we're now being asked to take into banks and insurers. I suppose the other half of your question is the slightly broader question about capitalism and what does it deliver? What does it deliver into an economy? What does it deliver socially? What does it deliver, environmentally? And I've upset a few economists by espousing radical views about responsible capitalism and the current legal construct in most of the Western world around shareholders and directors' duties to shareholders and the primacy, if you like, to quote Milton Friedman, of the shareholder rights, against that notion, which already exists in a number of countries, that's only part of the equation. So companies being responsible to their communities, to their employees, to the environment, a wide range of other stakeholders who actually need to be taken into account. So I do think in that broader context, I mean, the two issues of if you like, of conduct and responsible capitalism, if you want to call it that, certainly align. And I do think the corporate world is now waking up to the issue that, first of all, they have a responsibility for climate change and the environment and the health of their people, the health of their customers, the validity of the product that they sell. But investors too are now beginning, as you know, of course, better than most people, investors are now beginning to see that as an important part of the bargain. And there's a bit of an issue about whether this will change fast enough. And I think the Sustainable Finance Forum you mentioned was pushing for a much more radical re-engineering of the economy in order to deliver a much more sustainable financial world that we live in. But these are all things that someone like the FMA needs to be on top of and comfortable with and able to influence company boards, fund managers, investors. We talk to the ACC and the super fund, for instance, on a fairly regular basis about what they're seeing and where their mandates may be shifting or what they're asking of their fund managers may be shifting. So we're in a time of real change, and COVID and its impacts may or may not push that change considerably further forward, considerably quicker than it would have gone. I don't know, it's too early to tell. We may be too busy trying to survive to do some of the good things. I think there's an opportunity there. So so conduct and a responsible financial system, very much in the minds of the FMA and the Reserve Bank at this point.
Very good. I mean, it's great to hear that stuff. I'm sure you've got lots of listeners on Zoom and Facebook who are sitting there nodding their heads over that one. Rob, we've had some questions come through. Margie Russ has asked about the inquiry that you've had into misleading information on green bonds and labeling of things ethical or green or responsible or sustainable. Can you just sort of give us an update of where that work is?
Yeah, I mean, we're still in the midst of that work. We are doing a lot of work, particularly around managed funds, retail managed funds, around I call it labeling and whether the product does what it says on the tin. So we looked at and are just about to publish a report into active versus passive management, and where fund managers say they're active, are they really? And when passive managers say they're passive, are they really? And also some element of who's charging what for different parts of that strategy. The labeling of products as green or socially responsible, is a piece of work we're doing that's important to us. There are some significant initiatives underway globally, which we're involved in trying to come up with some protocols for badging of bonds and funds as green or sustainable or ethical or whatever you want to call it. Complicated, these are complex issues as to whether they become terms of the instruments and as a result changes the nature of those instruments. But I think it is critical that if investors care about this, that not only does the industry not just see it as an opportunity to sell a new product or charge a bit more for the same product, but actually understands this is a way to engage an investor base, and probably a younger investor base than perhaps might have come forward, before this. So all of those issues around whether products do what they say they're going to do, and whether fund managers or bond issuers or whoever do what they say they're going to do, that's clearly a big area for us. So the disclosure team at the FMA is going to be pretty busy doing those reviews and putting out those reports, and really trying to generate the sort of interest that I know you have amongst the investor community, so that this becomes some momentum of its own becomes injected, because it has been a little bit frustrating trying to work out how to engage people in their investments. And I think those sorts of topics seem to be top of most people's minds. So, we're going to push quite hard into that space.
Yeah, that sounds good. The issue of disclosure, I think, is so closely aligned with misleading claims, because at the moment part of the difficulty is around comparable metrics on what people mean by ethical or sustainable. And I think if we're able to have more comparable reporting in the same way that we now do on financial metrics, on other things, then it starts to give the public a clearer and more objective set of measures. And in a way, mindful money is to some extent trying to fill in some of those gaps, because there aren't ways for the public to be able to necessarily do all the research that they would have to do.
And I know I probably sound like a regulator trying to create more work for itself, which is an accusation people love to throw at regulators. But, having frameworks where people can make comparisons between products, between providers, is critical for people to be able to make informed choice and to be confident in their decision making. And people won't participate unless they're confident that they've got the information they need and they can trust it. So I'm afraid that there will need to be work on some frameworks. There will need to be works on some standards. There will need to be monitoring of those standards. But if we don't do that, there'll be a bubble of badging products because that's what people want. And then people will lose faith and we'll have missed a golden opportunity. So, unfortunately, it creates more work and probably more cost for a lot of people. But, this is, as I said earlier, the single biggest growth area for investment products. And globally, because it's such a global market, we have to get it right. We have to get some standards that are applied, across the globe and are instantly recognizable by both institutional and individual investors.
We've got a question from Tracy Patterson. Thanks, Tracy. Talking about, can you expand any on, I know it's in your future plans, but on FMA's role in monitoring and perhaps enforcing mandatory climate change disclosure under TCFD, Task Force on Climate Related Financial Disclosure, and or whatever standard we may measure against in New Zealand. And related to that is a question from Pete who says, also, can you give us a view on, you and I quickly talked about Chapman Tripp's legal opinion on the duties of directors related to climate change and disclosure?
Yeah, I'll try. I mean, the New Zealand moves on climate risk related financial disclosures are still in their infancy. A cabinet paper, I think, has gone up, or if it hasn't gone up, is about to go up. So no legislation drafted yet. But as I said earlier, the plan is to make it, the current plan, as I understand it, is to make it mandatory, certainly for listed issuers, certainly for some big public interest entities, and have the XRB create that standard framework, and the FMA monitor it and enforce against it. And obviously there will need to be a lot of work with the corporate and the fund management industry to try and create that framework. The current government is in a hurry, which is good, because I think this stuff needs to be done quickly. There is a challenge there about, to what extent New Zealand's typical challenge, do we want to be the leaders and therefore risk spending a lot of time having to backtrack, or do we want to let the Brits, for instance, who are quite advanced in this, and the Europeans who are looking at it, create standards that at least would be applied across Europe, which would make more sense to us to take, rather than end up with some New Zealand specific standards that only apply in New Zealand. So I think that debate is still to land. But yeah, certainly Minister Shaw and Minister Fafo and a couple of others have been pushing this hard through the government agenda. So I guess it somewhat depends what happens in the election, but certainly if the current government gets back in, we are expecting to be given the mandate to do that. So that's as far as it's got.
Yeah, and just to say on that, Minister Shaw, Climate Change Minister, will be joining us on a seminar on the 2nd of September. So
Right.
Hopefully by then we might have some news.
Yeah.
Not long before the election, so by then we may have some news on the future of legislation.
Yeah, he certainly bumped it up the priority list of what was an already busy government ahead of the election. So good for him on that. What was the other one?
The other one was the legal opinion on the duties of directors with regard to climate change and sustainability issues more broadly. Yeah.
I think I remarked caustically to you, Barry, that I regarded it as a legal opinion that stated the blindingly obvious, in that I think it's unchallengeable that directors of listed issuers, for instance, have to pay attention to any material risks to the company's prospects, and that's any type of risk, and climate risk or climate risk related issues, or climate change related issues would clearly be in that list, in my opinion. What's interesting, and we talked to Matt Winneray and the folk of the Aotearoa Circle who did that Sustainable Finance Forum. What's interesting to me is that there had apparently been enough pushback from directors when told that they needed to consider the risk to their business prospects of climate change, that the forum saw fit to go and get an opinion. And Chapman Tripp got it exactly right in the opinion. I completely agree with everything they had in there. So I suppose you would say I might think it was very clearly the case, but the fact that there was enough resistance in the director community to it justified the issuance of the opinion. And it's a good signalling opportunity to basically directors to say, I'm sorry, we're going to hit you with yet another risk that you need to be considering, in looking at your company's disclosures. And not only do investors care about this, but actually it's your duty as a director to get these disclosures correct. So it's all pushing into the same place.
As you say, it should be blindingly obvious, but sadly, it isn't in many boardroom tables. So good to have it out there. We're coming towards the end, so if anyone wants to lob in a question, you better hurry. One sort of big question from Louise. Hi, Louise. Thanks for asking this. She's talking about shareholder primacy and the kind of who's accountable to whom, and is it to wider stakeholders or shareholders? And she asks the question, what's broken? Is it that the mechanisms of shareholder primacy aren't working because management and board aren't listening to the things that they should be listening to, as she put it, sort of groups like Mindful Money and social activism and those who are concerned about the company's impacts, or is the problem actually wider than that, and that we need a different model than currently a system which is by legislation very much shareholder oriented?
Yeah, lovely question, and you're at risk of a long rambling monologue. I'll try and be brief. Both is the answer to that. In that, I've spoken a few times that I think the notion that of shareholder primacy, the Milton Friedman notion that really it's all about serving the shareholders and everything else will flow behind. I think that's outdated. It's not sophisticated enough. The points he was making at the time, I think, were probably perfectly valid, but we live in a more complex, nuanced world. And I certainly feel that any director that says, I must exclusively serve the interests of the current shareholders is missing a trick. Now, I have upset some economists and some law professors, which is excellent, because two of my favorite things to do in the world, because company law in most jurisdictions, including in New Zealand, is lagging behind where I'm going with this. So to be fair to many directors, the legal duties aren't as nuanced as they need to be. So I think that needs to be fixed. And then I guess I would just throw out a bit of a hand grenade in relation to the broader question that was asked. I think actually the whole contract between shareholders and companies, I don't know if it's 100 years out of date, but it's certainly 20 years out of date. You've got long-term shareholders, you've got shareholders who hold for a fraction of a second, you've got hedge funds who own, for a couple of days, you've got people short selling. The whole notion that the shareholders drive the direction of the company is in some respects, to be very challenged. And so I think you can only really fix the first thing if people are willing to take a step back and say, maybe we need to rethink the whole basis of the engagement between companies and shareholders and work out what other stakeholders need to be in the mix. Should you differentiate between types of shareholders? Did you differentiate between how long someone's held the shares? All of those complex questions that people don't want to deal with because, we've built the whole model on something else. Probably we need to answer some of those big questions in order to move more quickly on the sorts of stakeholders that you're interested in and we've been talking about. Because I think too often you're going to hear someone say, but the law says X and Y, and you're telling me it should be X and Y and Z. Is that a moral impost, or are you saying there's a legal duty? And I have a little bit of sympathy with some of the directors I've been badgering that it's easy to point to what investors want. It's not so easy to point to the provisions in the law that tell the director they should take that into account when they make big decisions for the company. So I do think it's a challenging topic, but the structure of that system is, in my view, badly outdated.
Yeah, I think tackling company law and rewriting the notion of fiduciary duty would be a great thing to do. It is rather hard to point to anywhere around the world where that is happening to any serious extent. I guess a little bit in South Africa, but not too many other places. I think we're going to have to wrap up there, everyone. We design these as short, sharp bites, and in kind of today's world to have a time frame is sometimes a good thing in terms of people being able to digest issues within our busy lives. Just a reminder to everyone, next event on the 29th of July is going to be a really interesting panel on alcohol, and we're talking about alcohol and investment. Includes Nikki Jackson, who's Alcohol Health Watch Director, and very thoughtful on these issues, David Beattie from Booster Funds, and Booster has got some funds that have divested from alcohol and some that haven't. And again, very thoughtful on this. So please join us for that next week. A huge thanks for tonight's discussion to Rob. This really fantastic to have your thoughts, Rob, and really appreciate you coming.
My pleasure.
Yeah, great, and more power to you in your thoughts about the future. That was quite inspiring. Thank you. These seminars are kind of supported by some generous donors who have helped us put them on. So thanks very much to Generate, to Booster, and to Harbour Asset Management. Thank you all very much. Tune in, please, next week, Wednesday at 7 o'clock. Again, thanks very much to Rob, Everett, and good night all. Ka kite anō.